Hello, welcome to the Wealthy Trades Daily Market Forecast for May 12th, 2015. Let's get rolling right away. We had a decent down day yesterday in the market. We did have some stocks flip into an uptrend, enough to swing us into an uptrend. Interesting enough, as we've been talking a while, other than a couple days last week where we got the percentage of trend when we were going in that downtrend, right around that 60% mark. This entire month and a half, it seems like we've been basically hovering around the flat line. What I mean by that is we've been hovering with about half the stocks in the S&P moving up and half the stocks moving down, and it's been very difficult to find a true trend, and that's kind of in the environment we're in right now, where market's sitting near this all-time high but can't break out. A lot of the stocks are trying but can't, failing, and the quality indicates that too. So interesting though, yesterday what we did is we went short NEE. This was a decent trade, actually pretty good trade, up about 1%, and then we were long EMN. This was down about 1%. So overall, about break even for the day in comparison to a market that was down quite a bit. Not too bad. All right, that's the purpose of those days. We roll in and the market is in a direction, but the quality's not that good. Well, the reason why we do those hedge trades, anytime we do a pairs trade, anytime there's a pairs trade day, we're not looking to make a ton of money. Some days we can do really, really well and get great trades. But what that is it's really, you've got kind of one of two choices. Either do kind of a hedge trade or a protected trade, right? You go long one sector and short the other sector like we're going to do today. Or you sit on your hands, all right? Those are days that maybe they're not the greatest days to trade, and that can cause some frustration in the trader's mind, because especially in the market we're in right now, you've been sitting on if you're a trader that doesn't do any hedge trading, right? Either if the quality's up and the trend's up, and I know guys that and gals that do this, then they sit on their hands if the quality's below 50%. They only trade on those days that the quality's above 50%. They've been sitting on their hands a lot and testing their patience, and that's a difficult thing to do as a trader, because I've said this before, if you're a professional trader like I am, then a trader gets paid to trade. We don't get paid to sit on our hands, but sometimes the best trade to take is no trade at all. So, but anyway, I do a lot of hedge trading because we can catch those kind of unpaired type of moves, meaning, like today, we're going to find a stock in the XLB to go long, and we're going to find a stock in the XLE to go short. And, there's some days that we can catch these great moves in a market that kind of doesn't go anywhere, or maybe moves in a direction aggressively, and we catch the right stock. So, but before we go into that, so again, yesterday wasn't all that bad. It was about a break-even day in comparison to a market that opened up at 211.57 and closed at 210. 61, so down about 0.4% or so. I've been talking about these levels, seems like forever. Okay, we're still talking about these levels. We got to break and close above this 212 level. We have to do that. If we don't, we're probably going to be falling. Okay, that's pretty obvious because we're sitting right at that 212 level. If we break and close above that 212 level, I think we're eating up a lot of the sellers. The longer we stay up here, the more aggressive the break higher is going to be, if we don't break lower. So we've got to hold this 206 50, 207 level. If we break and close below this kind of pivot right in here that we put in last week, 206.76. If we break and close below that pivot, we're heading lower. In fact, we could be heading fairly substantially lower, and I'll get into that in a minute. If we break 212 and close above that, we're heading substantially higher. I've been saying that's kind of the area. 206, 204 to 206 on the downside. If we break that and close below that, even on a daily basis, we are heading to 180, 1800 in the S&P 500. That's my opinion. That's what I think we're doing. If we break and close above 212, I think we're heading to about 230, 2300 in the S&P 500. So I think there's about a 500-point range. All right, so about a 20% range that we're going to put in, depending on where we break over the next day, 2 days, 3 days, maybe this week, maybe next week, but soon. All right, this kind of real tight, 3% range we're in is going to dictate the next 15% in whatever direction, in my opinion. So there are key levels, all right, on a daily basis, more short-term basis. The key levels we need to watch out for is this pivot low that was put in place on the 6th at 206.76. We break below that, then we've already eaten through a lot of this buying pressure right here. So I think we're going to fall. We're probably going to cover this gap right in here, which is right around 202. All right, so we break 206.76. We're going to 20, probably going to test that 200 level. Okay, which is going to cause some longer term technical damage. But again, if we break the 212 level and close above that, all bets are off. On the upside, I think we're heading much higher. Now let's paint the bear case for a second. Let's say we break that 206.76 on that daily chart. What then? Well, here's the issue, and it's not an issue. It's interesting. All right, so we use longer term pivots on our weekly charts, and what we did is the pivot lows. All right, so to go into a downtrend, we need to break and close below a pivot low. Right, that puts us in a downtrend. If we look, we've been in an uptrend for a while, kind of shifted, for about a week into a downtrend and then back into an uptrend. But here's the thing. So we put a pivot low, a true key pivot low, in at 204.12. All right, so 204.12 is the long-term weekly, and the weeklies are fairly long-term, the long-term pivot low that we need to stay above on the S&P 500. If we close below that, then we may have some trouble. And I think what may happen is if we close below that 204 level, so that 204 is so key. So if we close, so let me back up. If we close below 206.76, remember what I said. We close below 206.76, then I think we're going to go down and test about 202. But if we close on a weekly basis, so then I think we'll get kind of a rush down, and there'll be a couple day big selling pressure. But we can get down to 202 and still not close the week below 204, right? Because we could get down there, on a let's say a Wednesday or Thursday, and then rally back on a Friday and close above 204. Now here's the thing: if we break that 206.76, I think we're going to 200. If we close on a weekly basis, okay, on a weekly close, if we close below 204, then we're in trouble. Then I think almost certain we're going to go test this. There's obviously some real big snapback buying pressure in here, and I think right around this probably 190 area is pretty key. And because we've already tested, remember the shift, right? So downtrend shifted back into an uptrend. Here's this whole like 200 area is the shift area. We're bouncing off of that. We break that, we are going back down to test this. Okay, so and by that time we'll be in a confirmed downtrend, because that 204 level is that confirmation closed downtrend area on the weekly basis. So again, long story short, I think this, if you kind of recap everything I just said, that 206.76 area is kind of really key. I think there's a very high probability we could go into a longer term downtrend. If we break 206.76 on the downside, I see 202 short term on the downside, which gives us a very high chance of closing below that 204 weekly pivot. If we close below that, I see 180. All right, 180 in the S&P 500. Or 1800 in the S&P 500, right down in this area here. So so 206.76 is kind of the key area we're looking at. That is a very, very key area. So you know what we're doing on a weekly basis? We are long in KR. KR was about break even yesterday. So not bad in comparison to a market that was down. Again, not too shabby. We are still long. We'll be long all month long in the XLV. What we're hoping as longer term traders, in my longer term positions, what I'm hoping that the XLV can hold up. If we are going to start breaking these levels on the downside, I'm hoping that the XLV can hold up, decently. Anytime, we are in stock within the market like the XLV or Cardinal Health like we are, then we're going, and the market rolls into a downturn, we are going to take losses. But what we want to do is we want to limit our losses in comparison to the market. And then next month, what I'm hoping is if we do start to break the downside levels, I'm hoping that the quality, and I can almost tell you this will be the case, the quality will be below 50%, so therefore we'll start to do hedge trades, which then at this market, and this is the power of wealthy trades, listen to this, if we do, let's say we start to roll over this month, right, and the XLV, let's say the overall market is down this month 2.5%, and the XLV is down 3%. Oh, geez, that's horrible, Tyson, we underperformed the market. If that happens, then we're going to roll into June, all right? And the quality is going to be, we're probably still going to be in an uptrend on a monthly basis, but the quality is going to be below 50%. Therefore, we'll do a hedge trade. And let's say the market continues to roll over and we go down to that 1800 level or 180 on the SPY that I think we're going to go down to. Well, we're going to be okay because we're doing a long and a short pairs trade long term, and that's where we substantially outperform the market because we're always staying with the current trend. In fact, we're always kind of ahead of where the market's going to be. We might take on some pain, much like the market. If the market does roll over fairly quickly, we're going to, as a trend trader, we're going to take some pain short term, and then overall, we're going to long term outperform, and that's what we do. So again, we are still long the XLV. We're going to hold that all month long. And probably, if I had to guess, I think we are probably maybe going to break those downside, that 206.76. If we do, we're heading lower. If we do, then the quality is going to be below 50% for the month in June, and we'll start to do some hedge stuff. For this week, we are long in the XLP, and KR is our stock, and I'm going to hold that all week long. I can potentially look for some clues on what's going to happen. But KR, I think this is a good long position, and again, it's on a weekly basis. If we hit this downside low of 70.46, which we could get a sell-off. I'm going to add to the position there because that'll be a pretty aggressive sell-off, and I think that's a good area to add. So let's figure out what we're doing on a daily basis today. We're going to do a pairs trade. All right, we're going to do a pairs trade because we're in an uptrend. It's a horrible uptrend. It's not great. It's 50.8% of the stocks are moving up. That's not great. Give me a second here. But the quality of that uptrend isn't good either. 44.2. So we're going to go long the XLB or long in the material sector. So I'm going to move the stocks within the material sector over into my portfolio. I'm going to do this fairly quick. I'm running a little behind. I wanted to get these posted soon. So I'm going to move that into my portfolio. As I do, I want to talk. I'm going to do my pair down technique. I'm going to find all the stocks that lose money on one of the sides, like NEM, get rid of it. IFF, get rid of it. See, I'm just looking over here. If it loses money on one of these, then I'm getting rid of it. So FCX, get rid of it. AA, get rid of it. And XLB, get rid of it. Okay, so these are my top four. Now I'm going to look for the one with the widest spread, ATI 32 and 13. That's better than 19 and 9. 36 and 15 is better than 32 and 13. So EMN is better, and it's better than that. EMN is going to be our long position, but we got to pair that. All right, we got to pair that with the short position because the quality is below 50%. So the best sector to go short in, and the futures are down quite a bit right now. The futures we're probably going to get an open. The S&P 500 is probably going to open down probably between 12 and 15 points at the open. So, pretty, half to 0.75% down at the open, so that'll be interesting. And energy is actually up a little bit, which is okay because that gives us a better entry, all right, with our shorts. So now we're going to bring all these into our portfolio, find the best shorting opportunity here. All right, and we're starting to hear a lot of talking heads about, on TV, hey, what's going on with the markets? What happens if rates go up, etc., etc. I'll talk about that in a minute here. If I have some time, but let me do my pair down technique. Let me find our short that we're going to pair this with today quick, and then I'll start talking about some of that. Just looking for all those stocks that lose, any stock that loses money. All right, so now we've got it. So now I'm going to do 38 and 25 compared to wait a minute, is that 38? 30 and 25 compared to 26. So APA is better. 26 and 11 is better than 26 and 17. 26 and 11 is better than 19 and 13. 26 and 11 is, come on, better than 26 and 25, and better than 28. Okay, so here's our trade. We are going to go long EMN at the open. All right, and close at the end of the day. You can look at the levels to win levels as areas to trade at. In fact, on a day where the futures are down like they are, what you can do, all right, this is it's not advanced, but what you can do is you can say, I'm not going to enter at the open. I'm only going to enter EMN if it hits the expected downside, right? Because it's in an uptrend. If it hits the expected downside, it makes money. So trading at 79.32, entering there is a good trade. I'm going to enter at the open, close at the end of the day. And then CVX, what you could do is you could also do the same type of thing, but do it on the counter trend side where if it rallies up and hits 108.21, you can enter there. I'm going to enter at the open and close at the end of the day. So CVX is my short and EMN is the long. So real quick, before I post this, we are stuck between kind of a rock and a hard place right now. We've got the bond rates and the treasuries, all right, long-term government debt essentially in our country rallying up a little bit and putting in a bid. But here's the issue. The issue is our Fed. I'm actually a fan of what the Fed did originally in 2009, 2010. Right? They needed to provide liquidity to the market to kind of save us, right? But we stayed low much too long, and that's going to be the issue when it's all said and done. Because now, if God forbid we get true inflation, okay, then the Fed will have a mandate to defend that inflation, and a strong dollar is kind of helping that out, helping get keep inflation down. But let's say we do go through strong inflation. Let's say that happens. The Fed will have a mandate to start raising rates. Maybe the market might take the Fed and knock them off their low interest rate policy. But here's the issue: we cannot go into a higher interest rate environment right now because I think all things in the economy, things are really clicking on almost all cylinders. So if they're clicking on all cylinders, why are we in such a low interest rate environment? That's the oxymoronic thing, and the market moves in ebbs and flows. It's a roller coaster, right? We click on all cylinders, and then we go into some type of recessionary environment. Consumers tightens up, etc., etc. It goes through ebbs and flows, and so if we're clicking on all cylinders right now, the next step is the consumer to tighten up a little bit, start saving, and that will essentially slow the economy down, which could take us into a slower recession or slower growth. And if that happens, then the Fed will keep interest rates low, and that could potentially spark something where the consumer really starts to tighten up and they start to get scared. And anyway, it's a rock and a hard place right now because we really don't have any more bullets. We should have started raising rates probably in about mid 2012, raising rates where once the market gets to a level of clicking on all cylinders, the next thing that comes, the consumer slows down, we start to recess a little bit, then the Fed has some bullets. But right now, man, if we go through some inflationary pressures, the consumer starts to slow down, which means it puts pressure on corporate earnings, which means it puts pressure on the job markets and incomes. This could potentially get bad. It could be great. We could grow ourselves out of this, and that's great as long as inflation doesn't start spiking up, and as long as the consumer doesn't stop spending, then we're good. But if the consumer stops spending and if inflation starts to spike up, that's really bad because that's going to slow the economy down, and the Fed doesn't have any other bullets. Anyway, that's my 2 cents. I'll talk a little bit more about that in upcoming videos and give you kind of my idea of what could happen. But anyway, let's make it a great day. Today we are making, we're going to go long EMN, short CVX. Let me know if you have any questions. Email me, info@wealthytrades.com.